Well, good morning and welcome back to Trader Talk. I'm Kenny Polcari, your host, and today we're sitting down with Ali Furman, who is head of Pricewaterhouse Consumer Markets Division. We'll talk about that in a little bit. And Aadil Zaman, who's a partner at Wall Street Alliance Group. And we've got so much to talk about because there's so much happening. We can spare the whole conversation around the geopolitics at the moment because that's kind of top of everyone's mind. And last weekend we heard that Iran said no, and the president said, okay, that it's over, and oil went higher and all that stuff. But let's talk first about the U.S. capital markets. And in your case, let's talk about that have to. I mean, Aadil, tell me, where do you think we are? Do you think we're in a K-shaped economy, or do you think it's something different?
Yeah, absolutely. I think we are definitely in a K-shaped economy. The top end of the K is the main driver, right? So that if you look at our GDP, 68% of our GDP is consumption.
So who do you think is in the top end of that K? What demographic?
It's basically 50% of that GDP is being driven by the top 10% of the consumer.
Top 10%.
Top 10% of the consumer. And 90% of the stocks are owned by the top 10% as well.
Right.
So these are the consumers that are driving the economy. And because this consumer is very healthy, the economy is doing really well. And then we got the unemployment data recently as well. And that's also at around 4.3%. Not bad.
Historically low.
Historically low.
And it's been there for a while.
Right.
That really has not moved.
Right.
The unemployment rate.
Unemployment rate has not moved, but what we're also seeing is that wages are growing more than inflation.
Right.
So we've got a healthy consumer. The consumer is spending.
Which is a more recent trend, though, that wages are starting to grow more than inflation.
Correct.
Do you agree?
Correct.
Okay.
I agree. So because of that, because of this high-end consumer, they're driving the economy. The economy is doing well. But what we are also seeing is this crazy amount of AI-related capital spending. The hyperscalers are poised to spend about $800 billion this year and about $1 trillion next year, right? So that is another big reason why the economy is doing well.
So let me ask you a question. Yes, I understand CapEx spending has exploded, right? Maybe more so than everyone thought. But how much of that is really due to actually buying more product versus paying higher prices for the product? So are you actually buying more, or are you buying less of the product?
Well, I think it's probably like you buy both, right?
Both.
Like it's both. Prices have gone up for sure.
Right.
But when you put that kind of money in the economy, it is going to have an impact.
Agreed.
And that's why we are seeing that now companies that are actually what we are calling the AI enablers, which is the brick and mortar companies which are building the infrastructure for AI, we are seeing that those companies are doing extremely well as well.
So let's talk about AI for 1 minute between both of you. So how much of the AI are you guys seeing? Maybe Pricewaterhouse just in general. What are you seeing out there in terms of how businesses are using AI and agentic AI? And do you see a real threat? Do you see a real threat to employment, or do you see the AI creating jobs that we maybe don't even know exist yet?
Yeah. So I picked this question up from two different angles. So I like to talk about it from the enterprise angle, so what businesses are doing and where the winners are thus far. And then I love talking about it from the consumer angle, too, on the agentic commerce side of things. So on the enterprise side, listen, we've gone through the past 36 months and we've learned a lot, right? So you saw that study from MIT that was reported by the Wall Street Journal. 90% of all AI initiatives fail and they don't have ROI. I think we're past that point now. We now have proven playbooks within certain business functions, like particularly in supply chain and planning, in procurement, in finance, where we know what you need to do with agents in order to take cost out, gain efficiency, and it hits your bottom line from an ROI standpoint. And I think the industries that have moved later, many of which are consumer industries, CPG and retail and hospitality, they're going to benefit from some of those first mover industries like the financial services sector, the insurance sector, and certainly the tech sector. So we're in a decent spot there. I think the companies that started early with a lot of like throw spaghetti on the wall, a lot of AI experimentation, listen, it's okay to experiment. We needed to do that in the early stages of this wave. Now we can be a lot more intentional and strategic. And where I'm seeing winners in terms of P&L ROI are the ones that are having top-down AI initiatives that truly relate to your business strategy. You need to use AI to power your business strategy. It shouldn't be just a tech-led initiative by your CIO or your tech team on the side. It should be embedded into your business strategy and really intentional on where you place your bets. You still need that hybrid approach. You need to put it in the hands of your employees. Everyone needs the tools. Everyone needs to be upskilled. From that standpoint, I call it an 80% psychological challenge, a 20% technological challenge, because the technology is amazing. it's going to continue to evolve.
I don't know if you guys saw this, but I noticed it over the weekend. Suddenly I saw this Chase commercial. It's a JP Morgan Chase banking commercial. And it starts out with, with the guy talking to Alexa, saying, Alexa, turn the music off, or Alexa, turn the heat up, or something like that, right? Because he's by himself, he's talking to a computer. Then he gets in a car and he says to the driver, take me to, and there's nobody driving the car's driving itself, right? And so then it goes into a Chase branch. And it says that, then he goes to the coffee shop and he says to a robot, I want a cafe latte, and this robot hands him, so there's no human beings in this other than him. And then it switches to this Chase commercial, this Chase branch that says Chase is building branches where humans can come in to talk to humans using AI, but there's going to be human beings sitting behind the desk, not talking to a computer, which I actually think it's a brilliant commercial, because I think that's the big fear out there, is that all these people are going to be out of a job. I'm not in that camp. I don't think people are going to be out of a job. Do you?
No, I don't think so. And I think that's part of the, if you look at the unemployment rate, what the headlines have been catching is the layoffs that are being happening because of the AI, but the headlines are not catching the jobs that are being created because of AI.
Right.
In the construction, in the utilities, in those sectors. What we are talking to clients about in AI is the 3 phases of AI.
Okay.
So phase 1 is your hyperscalers, NVIDIA coming out with their earnings, probably going to crush it, most likely.
And the traders will sell it off because they ran it up ahead of earnings, and they'll sell it off.
Because it's priced to perfection, right?
Correct.
So that's probably going to happen. But these AI winners, the hyperscalers, are priced to perfection, right?
Correct.
Phase 2 is your AI enablers, the brick and mortar companies that are building the infrastructure for AI. So think about utilities, construction, industrials. And phase 3 are the AI beneficiaries. These are companies who are actually now implementing AI into their businesses and seeing meaningful productivity gains. We are guiding clients more towards phase 2 and phase 3, which is the enablers and the beneficiaries.
Right.
Phase 1 is a bit
right.
pricey.
So you're in the business of advising clients and talking to clients about opportunities and all that. Do you see AI taking that job away from you?
The kind of stuff that I'm doing for clients, no.
Right.
But again, there's going to be different levels, right?
But clients have to enjoy talking to you.
For sure. Yeah.
Right. So they don't necessarily want you to go away.
They don't. And also, Kenny, you have this experience as well, and we share that. But with clients, what we see is it's putting different pieces of the puzzle together. Right. Portfolio management is an important part of it. How does it relate to tax saving? How does it relate to your estate plan?
Right.
How does it relate to the asset protection? That putting the puzzles together optimizes the benefit to the client of a financial advisor, which I think will be difficult for AI to do on the high end.
Right.
So if we are talking about...
I think people that have worked a lifetime and have accumulated assets want to talk to human beings. They can use you as the advisor. You can use AI and you can use technology, but I think someone that's accumulated. Now, if you're talking about some 30-year-old kid that's putting $100 away in his retirement account and he's got $30,000, no, he's happy to do it on AI. Not a problem.
Yeah.
But once that person turns 40 or 50 or 60 and he's got $3, $4, $5, $7 million in the bank, he wants to talk to a human being.
Let's talk about that.
Yeah, okay.
There's something interesting going on between generations. Okay, so
agreed.
We have Gen Alpha, who's 14 and younger, who are AI native.
Right, that's right.
Then you have Gen Z, average age 22, oldest age 29, who are digitally native but very AI savvy. Then you have millennials, X, and boomers. All of them are using AI. 60% of consumers have already shifted over to AI platforms exclusively for search and discovery of brands and products. So away from legacy Google search to AI platforms. Gen Alpha trusts AI implicitly. 40% of them are using it every day for fun. So think about when they grow up, what they're going to use AI for and be comfortable with. But my answer to your question, though, about our job's going to be lost, and I actually am very pragmatic about it. Yeah, just like every kind of industrial revolution wave we've had, there's been machines that have replaced human labor. I think we're going to see that here. But I also think there's going to be new industries and new job opportunities.
Created that we don't even know about yet.
100%. In addition to, I think humanity and empathy and products that have heart and personalities behind them are going to be at even more of a premium than before, because you're going to probably see a bit of a backlash to all the AI that's out there.
Right. I think that's right, and I'm in that camp. I talk to some people who are so bearish, and they think the end of the world is coming. And oh my God, I'm like, what world are you living in? Or am I missing? Or am I missing all the signs? I will say I'm in the boomer generation, right? So I look at it. I have a very like I can never see myself getting in a car that doesn't have a driver. Like a robot. Like
Right.
I would feel unsafe when people make fun of me and they say, what are you talking about?
Well, in all of our surveys and research around this topic, the number one barrier to using AI is trust.
Right.
It is. And generations, millennials and older, are the most skeptical about it, understandably so.
Well, but the other thing is that AI, LLM models they hallucinate a lot.
They can make mistakes.
Unless if you don't know the answer or what you're looking for and you just let it give you the answer, you could be putting something out there that's completely erroneous.
This is really important, something a lot of companies in the consumer sectors are focusing on. So because so many people have shifted over to using AI to search and discover brands and products, you have to make sure that you're not becoming invisible.
Right.
You have to make sure that you have product attributes that are machine readable,
Right.
that the agents can find you.
Find you.
Because the way that people are searching on these AI platforms, the average search is 30 words. The legacy Google search, the SEO search, was 5 words. So people are searching for outcomes. They're searching for high consideration purchases that impact not just high dollar things, but like wellness and psychology and like things that are very personal to them. So the searches aren't just for something that somebody knows they want. You know what I'm saying?
Yes.
So it's really important to make sure your brand shows up in the right way with the right sentiments around the right types of searches.
Right. So
Very few companies have.
What's that going to do for Google search?
Well, they're already evolving. So you're seeing Gemini now as it's completely taking over search.
Right.
And obviously ChatGPT was one of the very first ones out there. You're seeing Anthropic with Claude. Perplexity's out there too. So
is the whole SEO model going to go out the window?
The SEO model is,
it's going to die a natural death.
It's being cannibalized by this
So it's
AEO model.
Right.
Yeah.
That's interesting. But it will be. But you see, that's one of those changes, like everything, that's just going to happen. It's going to evolve into something
It already
different.
is. It already
Right?
is. And companies really need to pay attention to it. And soon you're going to see agent-to-agent shopping. So agents are going to shop on your behalf. You're going to be able to delegate to agents, particularly for repeatable purchases, for commodity-type purchases, with parameters.
That's already happening, like in Amazon.
Yeah,
You can Amazon sends you a message, say, you bought this a month ago, whether it's detergent or oil or cleaning fluids or something like that. That I have no problem with.
I think you're right. It's to some extent already out there, but it'll be even more frictionless and more seamless, and it'll happen while you sleep. You won't even you'll just set it and forget it.
Sure. I think what's also happening is that AI is people that are able to interact with AI in the most optimum way, right? So we at our company, Wall Street Alliance Group, we deal with a lot of physicians. And a lot of physicians are finding a lot of use with AI because they already have the knowledge.
Right.
So they're able to interact with it and extract the information that they need.
Because they know when it's right and wrong.
They know when it's right and wrong.
But the same way as a financial advisor, if you ask it a question, you know what you're looking for. You can tell right away if the answer's wrong.
Absolutely. So that is why people that have the knowledge, like our generation is actually interacting with AI really well because we have the knowledge from before, right?
Right.
And I think it's going to be like anything. When the internet came about, people lost jobs, but then new jobs got created.
Right.
Yeah.
I think that's exactly what we're going to see with AI as well.
Right.
And it's not, there's other structural shifts in consumerism that are going to create additional jobs and additional opportunities.
Right.
Another one that we're following very closely is the wellness movement, catalyzed by GLP-1 weight loss drugs.
Right.
So
and peptides are now big.
Big. So if you look at the GLP-1 trajectory of adoption, as of December 2025, 20% of U.S. households have at least one GLP-1 drug user. That's 1 in 5 American households.
Right.
When you're on this drug, it affects your brain and your body. It has major implications on your spending patterns. You're reallocating your spending, not just in food and beverage, but in gym memberships, how you travel, your beauty regimen changes, different products are important to you.
Right.
And it actually affects spending for your entire household because you're now going on this holistic health journey. So you're thinking differently about what you buy for your whole family, including your pets. Right. So this is something really, it's true.
It's true.
It's showing up in the data. So it's really important, just as another, there's going to be new products and new industries and new opportunities related to this. Really, it's a wellness movement catalyzed by these weight loss drugs. That's going to happen too.
One of the things we were talking about off camera was that we deal with physicians. So one of my clients who's a nephrologist was saying that because of this GLP drugs, his business is down because people are not having kidney problems as much, right? So it has a lot of
headwinds and tailwinds.
Yeah.
3 years ago, when this drug first came out, executives dismissed it as a passing diet fad. They wouldn't talk to us about it.
Right.
Now we're talking to everyone about it.
Well, because you have to, because it's exploded.
Yeah, you have to have a strategy around ideally capitalizing on the tailwinds for your business and mitigating some of the headwinds, because there's both.
Right. So let's just flip to tech for 1 minute, because we're going to run out of time here, and I want to make sure that we talk about this. So, and we hit on it. NVIDIA is going to report on May 20th, which will really mark the end of this cycle of earnings season, right? I think we've mostly gone through it. And I suspect that NVIDIA is going to continue to, like all the other ones, just blow it out of the water. I mean, we've seen that. We saw it with AMD, a couple of weeks ago, right? When they reported, it was crazy. So talk to me from your perspective in terms of clients that you're talking to. What are their concerns about tech? Are they concerned about tech? Do they think we're in the beginning, the middle of this game, not even started yet? Tell me what you think and where your clients are at.
I think the what we are guiding our clients, we are actually underweight tech right now. Underweight tech.
Wow.
And the reason for that is that they are trading at premium valuations.
Okay.
And what we are advising clients is that with your tech exposure, the most important thing is to right size that exposure, right?
So when you say that, though, you still own it. Are you trimming it, or you're just not adding to it?
No, we still own it, but we are below the benchmark in the exposure to it.
Okay.
And the problem that we see is that when a prospective client comes in, sometimes they have 20% in NVIDIA, right? That's a problem.
Yeah, right. You have to manage around it.
And they don't want to sell it because they don't want to pay the taxes. Right?
That's right.
So I think that's one of the biggest problems that we are seeing. And we try to remind them that when the tech bubble burst, people lost their shirts. So it's important to diversify. And again, I think that what you've got to understand is you got to broaden your exposure,
right,
and add exposure to the non-tech companies, which will benefit from AI.
Agreed. And so I think you have to do that. But when you talk about clients that come in with concentrated positions like that, you can also create, do some indexing and create some losses that they can pair off against the gains.
Yes.
But you have to talk them through that.
Yes.
Right? They have to get comfortable with that idea, because I agree. They don't want to sell it because it's the hottest thing out there.
Yeah.
But they do need, if they're too concentrated, they do need to diversify. Especially if they're an older client.
Yes.
Right? Because if you're somebody in your 40s, okay, you could argue that you got 30 years to go. But if you're someone in their 60s or 70s, you might argue you gotta shave that a little bit.
Yes, and that's where the planning part comes in, right? You've got to talk about strategies where you can offset those taxes through things like charitable contributions or tax loss harvesting.
Right.
And you want to do all those, and that's another reason why AI is not going to replace all financial advisors who can actually incorporate planning with the investment advice as well, right?
So you tell me I'm still good. And I think actually, but sitting here as a podcast host having these conversations, AI is not going to replace this either, because people want to listen to people. So let's just talk about, as we're almost halfway through the year, let's talk about where you think we're going to be at the end of the year. Because I'm bullish on the economy. I'm bullish on the S&P. I have right now I have like a 7,600 target on the S&P. I reserve the right to change my mind, but that's kind of where I'm at the moment. So talk to me about where you or PwC thinks we're going to be.
Okay, year-end outlook, I'd keep a close eye on the affluent consumer. So we mentioned they're bolstering the entire economy. They are spending more smartly. They're trading down, but their spend year over year is up about 0.5 percentage point, and they're reallocating that spend that they saved into travel.
Right.
They're traveling. So keep an eye if that's going to continue. And of course, I'd keep an eye on the low-end consumer who's being, very much impacted by energy costs and gas costs. And we'll see if tariffs end up, further impacting their spend into late summer and they get further squeezed, and how that affects their discretionary spending.
But you know what? And I can come to you in a second, but I want to just make a point, because you talked about travel. If this conflict continues for much longer and oil stays, in the $100 range and higher, travel is going to suddenly get more expensive. Airlines are going to get more expensive. Cruising is going to get more expensive unless they choose not to pass it on to the consumer. I know the airlines are already passing it on. They've raised fees everywhere they can raise them.
Yeah. We just surveyed on summer travel plans.
Right.
Every income cohort, every generation. This is the one area people are not willing to compromise on. Right. 71% of all consumers plan to do some amount of summer traveling. the form of that travel may change depending on some of those variables that
And
you
maybe
talked
some of
about.
them have already locked it in. Maybe they've already booked that
Planned
flight
in
to Europe
advance.
and they booked it 6 months ago, so it doesn't make a difference.
Right.
But if you're making those plans now, I think that could shift the way you think about it.
Yeah, shorter trips, less airline travel for sure.
Right. Aadil, talk.
Yeah, so Kenny, we'd be cautiously optimistic. We do think the market is headed higher, but we are trading at all-time record highs right now. So investors should be prepared for a pullback, and investors should be expanding the breadth of their portfolios. One of the most under-owned areas, for example, in the market right now, we think is the international markets.
Right.
And what we've seen is that the relationship between the US and international goes in cycles.
Are you talking international developed or international emerging?
I think
both.
I think we do both. We do tend to like Mexico quite a bit because their tariffs are so low, below 5%.
Right.
So we think that their exports to the US is increasing. But when the tech bubble burst for nearly a decade, international outperformed the US. We think we are entering into a similar type of a cycle right now.
Right.
And also, it's a way of diversifying because if you invest in the IXUS International ETF, that's about 17% information technology compared to the S&P 500, which is double that.
Yeah,
right?
double that.
So I think we are optimistic. We think the market's going higher. We think investors are concentrated in tech. They should broaden their exposure into other areas, improve the breadth in their portfolios, and be prepared for a pullback.
Right. So I think that's fair. And I will also say, while I think the market's going to end higher at year end, I do agree. It's a midterm election year. So could there be some volatility over the summertime prior to the election? 100%. Yeah. I think investors should be aware of that. I think you should also be ready to pounce on that, though, because I think that pullback, just like the one we saw in March when the Iran conflict started, after it settled down, the market was down, nearly 20% on the Nasdaq and 13% or so on the S&P. I think that proved to be clearly a longer term opportunity.
Have a firepower in your portfolio.
Right.
We're always advising clients to that. You know, maybe an 80-20 approach is prudent for some people, where you have that firepower. If the market falls, you can rotate from your bond exposure to the equity exposure.
And I think people that got nervous when the conflict started and they sold out and they got nervous and the market went down and then they stayed nervous and they missed this whole move up, they could have missed the whole year.
It happens all the time.
I agree. It happens all the time.
I'll tell an interesting story. So when COVID happened and the market fell, a client of mine called me over the weekend and told me to sell everything.
Right.
I spent a lot of time trying to counsel them. No, they gave me, you're wrong. You should listen to me.
Right.
I said, I've seen this play out so many times. They sold out.
But it's ultimately their money. And so you do what they ultimately want to do. We can spend all day long trying to tell them, don't do it.
Guess what happened though?
Yeah.
They sold at the bottom.
Yeah.
Market shot up.
Yeah.
They missed out.
They missed the whole move.
They missed. And this happens every time the market falls. Some people get nervous.
Which is why and it's an old adage, I say it, everyone says it. It's about time in the market versus timing the market. Because you timing the market, you're always going to lose.
Timing the market is a sucker's game. It doesn't work, right? You got
timing the market.
Yes,
time in the market.
Time in the market is the key.
Is
the key.
Right.
And be diversified. Another issue that I see is that when the market falls, people think that they should take a lot of action.
Right.
The time to take the action is before. You prep right now, right? Right now, if you anticipate a pullback, prepare your portfolio for that pullback.
Right.
When that pullback happens, you don't start taking action.
Correct.
Right? Unless you're being opportunistic, you're sitting strategically on some cash, and then you deploy it.
But the issue is if you think the market's going to pull back and you take the action and the market continues to trade higher, okay, great. You're still invested, so you're participating. But that's always kind of the rub, right? How do I prepare, or when do I take that action?
So that's where the financial planning comes in, right? That's when you say, all right, based on your age, based on your investment objectives, how should you be allocated, and you balance it out.
Right. I will say, because I'm in the business and I am, like I said, at the end of the baby boom generation, I'm overweight tech. I know I'm overweight tech, but I love it, and I'm confident in the market. So there it is.
Absolutely.
In any event, look, we've run out of time again. I can't believe it. 25 minutes has gone by like that. I would love to have you back on the show maybe 4 or 5 months from now to kind of just see where we've ended up and what we think, where we've ended up, not only in the economy, but where we've ended up with all these topics we talked on today, tech and agentic AI and the consumer and the K-shaped economy, whether or not we're still in it or out of it. In any event, until the next time, take good care.
The following content is not intended to be financial advice and should not be used as a substitute for professional financial services.